Ladies and gentlemen, sorry for the slightly delayed start, just to allow people to get back from the coffee break, and I'm sure that there'll be more joining us in the first 10 minutes or so. So I'm honoured to be moderating this panel, and I shall introduce you to your panellists shortly. The topic today is management by brands, growth or decline in Europe. And really the intention is to examine not the growth of brands per se, because I think everybody believes that brands will increase their footprint in Europe, and probably the penetration could be easily over the next 10 years twice the number of branded hotels as we have today. I think the issue is around whether that growth in the brand footprint will be via management contracts or via franchising. And we've assembled a panel here today who hopefully will throw a lot of light on that debate and the factors that will cause the growth or decline of branded management and the growth of franchising. So let me first introduce your panelists to you. On my far left, very pleased to welcome Anders Nielsen, who is the CEO of Pandox AB. And Pandox have a very significant portfolio of hotels across Europe, and recently Pandox have formed a new operating company, Pandox Operations, which already operates 17 hotels, and also formed Pandox Asset Management, so for the first time beginning to offer asset management to third-party owners in addition to their own owned portfolio. So look forward to hearing Anders' perspective. On my immediate left, very pleased to welcome Nick Ski-Strachan, who's a partner with Berwin Leighton Paisner in London, responsible, among other things, for BLP's services to the hospitality sector. And in fact, Nick was ranked by Chambers UK as the leading lawyer in the hotel and leisure sector in 2014.
Pretty make it a leading lawyer, not sure there's anybody.
The leading lawyer.
He's promoted me.
On my far right, very pleased to welcome Ken McLaren. Ken brings a very interesting perspective to the debate, as he is the Executive Vice President of International Operations for Interstate. And Interstate are the world's leading third-party or white label management company, currently operating 435 hotels. And Interstate have brand relationships with Marriott, Starwood, Hilton, IHG, Accor, Wyndham, Residor, Hyatt, among others. So very interesting to get Ken's perspective on how this relationship is evolving with the brands. And last but by no means least, I'm very pleased to welcome Marty Kandrak. And Marty is the Executive Vice President in charge of development globally for FRHI, encompassing the Fairmont, Raffles and Swissôtel brands. Marty joined FRHI in September of last year, so 6 months into the job. So we'll check in with Marty, see how it's going. And Marty's here to represent the brands, and he brings a lot of experience and perspective to this debate. So he spent a lot of time, as most of you will know, with Blackstone. And I do recall a panel when Marty was with Blackstone, but before they'd bought Hilton, when I asked him a not dissimilar question: Marty, how is the best way to create alignment between owners and branded managers? And he gave me a 3-word answer: terminable management contracts. So that's now a feature of every FRHI management contract. I'm sure Marty will update us.
It probably still stands. It's just circumstances change. No?
Excellent. So just to get the ball rolling, I'll ask each panelist to introduce themselves, tell us a little bit about their business and how they're approaching this growth opportunity in Europe and how they see the growth happening. So if I may start with you, Ken, if you could sort of tell us about your business model and how you see this space evolving.
Well, I'm under pressure now because you said I bring an interesting perspective. Frankly, I don't know how interesting it is, but I'll do my best. As Frank said, we're the largest white label management company in the world. We have 450 hotels approximately. We have about just over 70 in Europe. And we manage hotels. We think we have the word alignment mentioned. Our alignment is with the owners. We operate the brands. We operate with brand integrity, but that's not our ultimate objective. Our objective is to produce return for the owners. We do that by a closer level of support. So, for example, typically our business model is we would have, for 15 hotels, depending on size, we would have a dedicated group of people who look after that group of hotels. On occasion, we do it specific to an owner if that owner is large enough. So we have immediate alignment with the ownership group, or we provide a service level that's different from the brands. At a hotel level, a property level, the people at the hotel understand that the hotel is in 99% of the times branded, but their alignment is again with the owner. They're not employees as they see it of the brand. And I think that's very important because obviously you've got a lot of human assets based in the hotel. And, you know, because we are closer to the business, because we are closer geographically to the business, because we don't work to the same level of brand priority, we think first and foremost we drive better top line. But then because we scrutinize brand costs, we have less costs that are charged back to the hotels from the center. But because we scrutinize the brand costs, we drive better bottom line. So I think, in short, that's sort of our model.
And if we sort of took a 10-year view, Ken, just to put you on the spot, with your 70 hotels now in Europe, from a zero starting point, where do you think you could be in terms of hotels under management in 10 years' time?
Well, I mean, put it this way, if we were here 5 years ago, we had 5 hotels, I think, in Europe, and 3 of them were actually in Russia. So I think this year we'll have 100 hotels in Europe by the end of the year. And I think as the model becomes better known, I think typically, previously, there was domestic third-party operators in the market, but there wasn't really an international player in Europe. There was domestic people working in 1, sometimes 2 countries. So, I think in 10 years, I mean, with the way that the popularity of the model and the exposure of the model within the community, I mean, we could be similar in size in Europe as we are in the States at the moment.
Yeah, so 400.
Yeah.
Fantastic. Anders, if I may ask you, please, to just introduce Pandox, because it's a big and complex company and growing rapidly, and in particular, to ask you from your perspective what the brands do well from an owner's perspective and what they do less well based upon your experience.
First, a short emphasize of Pandox. We are 20 years this year, and we have a very focused investment strategy. We invest in 1 asset, at hotels, and we have 3 business model. It's manage an hotel portfolio, it's hotel operation, and it's asset management. And we at the moment work with 16 different brands, and we also do a lot of independent hotels. So we do more or less everything that's in the area. You can say that has happened a lot in our industry the last 10, 15 years. Mega structure change had been in place. You can see that their international hotel company had changed their business model to become more a brand company, focus on brand development and on revenue and distributions. And you can also see that the consolidation is going on. That means for an owner that is few a good operator to talk to. That means that it is less company to speak to and cooperate with. That's why we form Pandox Operations. So we can operate ourselves, hotel ourselves, or we at least have a very strong position to negotiate when we meet a brand who is just there for signing a management contract. So you can say that this mega change in the market, meaning that owner need to be more active. So with that said, what can you expect from a brand? To answer your question, Frank, that is, if you look at the business model, they do, as I said, two things. They do brand development and they do revenue distributions. They are good at operate hotels. So if you ask for one of the big brands, a partnership, you cannot expect to have someone who work with productivity, management, segmentation, and product development. You have someone who is good at revenue management. You have someone who understands online marketing, but they don't understand how to get more money out from the pocket. And that has changed a lot the last 10 years. And I will say the trends now also is that owner became more and more active.
Thank you very much, Anders. That was really helpful. So, Marty, you do bring a very interesting set of skills and knowledge and awareness to your role in charge of global development for Fairmont. And, you know, I'm aware that Fairmont aren't really in the franchising business, and neither are Raffles, and to date, as far as I understand, neither is Swiss Hotel. So how do you see this landscape playing out in terms of branded management? Do you see more than enough opportunity for you to grow your brand family through the traditional management route, or is it getting tougher?
It's hard for, you slot me right in here after Ken says he does everything for free. And after Anders says that, but fair enough, that we bring nothing to the table. No, I think there's enough opportunity, of course. We wouldn't be here otherwise. But how much time do we have? This is I think this
Just
is
give
going
us your
in a bit
10-year
of a
development plan and
But look, I mean,
key
there
cities.
you got to keep in mind, we're a small, relatively small company, right? And I think there's opportunity for smaller, sort of specialized, if you will, companies in certain sectors or segments. I mean, if you put it in perspective, we have 120 properties, only about 11 Raffles, and then maybe a little bit more weighted towards Fairmont and towards North America, but say 65 or 70 Fairmonts and the rest Swiss hotels. On average, a decent sort of pace for us is to add, maybe 15 contracts a year, right? So this is, again, I think this we almost need to have two panels. We need to have a panel with the smaller ones that still, I believe it now, but Anders is not going to believe it. The smaller ones that specialize in a certain segment or a certain market and focus on really knowing who their owner is. And we can get into some of these other details. I don't necessarily agree with all of them, but there's some truth to some of the things we're talking about in terms of managing and cost structures and so on. But I can't comment on what it's like for one of the big players where it's more of an aggregation or brand aggregation game and it's more of a marketing company or not. But there are a handful of companies that have sort of in the range of 100 to 200 hotels that actually know all of their hotels, know all of their owners, know all of their markets. And, because we sign 10 or 15 or maybe maximum 20 contracts a year, it's not sort of a conveyor belt. So I think it's a little bit different. I know we're going to do a punching bag here out of brands and out of myself. Fair enough. We have a lawyer here and counsel, so I feel quite comfortable being on this panel. So it's like a 3-on-1 with a referee. But I don't think that it's always necessarily misaligned or not aligned, nor I think, no offense, that you can really create the kind of service or commitment or provide for the owner. That's not to say that you only manage Holiday Inns, right? But I think it gets a little bit tougher to be sort of focused both on the owner as well as the property and as well as on sort of retention of the value in the real estate as you move higher up the scale. So we can maybe, if we have enough time, pick apart those things. But I think there's enough opportunity. We don't have many markets covered. One of the things you should know, we always do almost always do, unless there's a special circumstance. Because we are relatively small, we don't necessarily try to have 6 Fairmonts in London. I mean, genuinely, you know, that's also, sometimes it's written in the agreement, sometimes it's not. We would usually not try to, you know, have, I'm sure there are Hilton people here in the audience, but we would not try to have 6 Hiltons together with 6 Starbucks. You know, it's a sort of Starbucks strategy, right? Within West Los Angeles. I mean, I think we would have generally, you know, 1 property in each market, maybe 2 if there are 2 distinct submarkets. And even if we didn't have some restrictions, territorial restrictions, I think we would go and talk to our owners. I think that's how we approach it. Partly because we're small enough. You know, different debate is, I mean, I like this model. Different debate is what happens 5 years from now, whether you could actually, you know, so live long enough, adding 10 or 15 management contracts a year, which basically add, you know, 10% of your EBITDA. That's a bit of a different discussion. I think we would have to go to the M&A panel.
Well, I think in this debate generally, I think you get to a level of quality in the marketplace where I don't think anybody would suggest that franchising is an appropriate route. And generally, it's where the DNA of the brand is intensely service-oriented. Yeah. And, you know, take a Four Seasons, a Mandarin Oriental, a Raffles. It's hard to see the brand owner wanting to relinquish direct control over the guest experience. So I think this debate generally is more about the market up to, let's call it 4-star full service, rather than something that approaches luxury where the consumers are arguably buying the brand's DNA.
Correct, right.
So Nick, turning to your perspective, obviously you're in a very interesting position seeing these deals being done and advising one side or the other, and you're doing, I guess, straightforward management contracts and third-party management contracts. And how's the landscape changing, and where's the balance of power?
I'm glad you made that distinction, actually, because I think the looking at what's happening in the brand management contracts, so I think so big international chains, their sort of forms of contract, they really haven't changed much at all in the last few years. I think there's a few things going on around the edges. You see a bit more key money maybe, but the sort of core terms of it haven't changed very much. Where there is a big difference is in what you can get from third-party operators. And going back to, I suppose, Marty's quote from a few years ago, what you can get is terminable contracts, which makes the whole negotiation a lot easier. You know, if you've got a 5-year deal and you know that the owner can get out at that point, you don't have to worry quite so much about future-proofing it for 30 plus years. Yeah. So it makes the whole thing a lot easier.
But can you really get a terminable contract? I understand. The discussion also is, you know, what's out there, what's available.
Okay.
Would there really be a lot of terminable contracts?
It's a mixture of. So not with. To kind of give it the whole picture. So the big international chains, not in a management contract. I think when I first started doing these deals, you saw occasionally ones with buyout rights for a few years' fees, but that doesn't exist anymore. Third-party operators will do much shorter-term contracts, so you don't have to worry about the buyout right. You renew it or you don't if you were happy. You do get ones that are maybe 10 years, but you can buy it out for a couple of years' fees if you sell. You get ones with much more real performance tests. I think the other bit to it is maybe to talk about some smaller operators that are out there that have got, I suppose they have got brands, but they operate hotels under the hotel's own name. So they're part of a group, but actually it's the hotel's name above the door, and that's the brand that's being built. And on a lot of those deals as well, you get maybe a 10-year contract with buyout rights for a few years' fees. So there's a whole sort of rainbow of options. And in a way, that's the biggest difference, isn't in the terms of the core management contracts that are out there. It's that owners now have many more options. If they get good advice, and hopefully they get that at the start when they can really shape what decisions they're making, they can choose whether to go down the branded management contract route, the third-party operator route. They can choose whether to brand at all and actually consider what impact will it have on the top line. Is it worth it for the fees? What's the cost of rebranding as well? I think that's the other piece to this. Particularly, a lot of the deals have been conversions. So the cost of actually changing brand or just keeping it with its own label is a big factor.
But wait, is it cheaper? Why are we having this debate, right? We have this debate because you tell me if Ken manages and Holiday Inn gives a contract, those fees that are effectively double what I'm going to charge. Not that I like to put myself in the same sentence with Holiday Inn Express and Raffles Dubai, but okay. So the fees are going to be double. You will tell me there's 10% more, 10 more percentage points on the GOP margin. But I'm not sure it's always the case, to be honest. I'm not sure.
This is why we're having the debate.
Good.
But I mean, I guess, Nick, just to address
Just don't
Martin.
let Anders get into this.
Anders is next. But just
Sorry, I suppose to be fair, sometimes the conclusion is, branded operations are the best option. It's difficult to kind of,
So when is that? When is that? When is that? Now you're on my
I was going to say, sometimes it's when an investor or a developer has fallen in love with that brand before they got started.
Well, it's not
That happens sometimes. I think otherwise it's where it's actually, I think for you guys, where you're talking about a small group that's very focused on its delivery, that works better, because if you've got someone who's delivering a luxury product and knows how to do that. So I think there's definitely something to that. Having said that, I have seen luxury being franchised, and it was kind of because the investor actually wanted to deliver something really, really amazing, and didn't believe that that operator that operates across loads of different brands all around the world actually could do that. They wanted to have complete
you had a good
control
advisor
over
on that deal, didn't you?
Yeah, the asset managers were pretty good, Frank. Yeah.
Anders, the point that Marty made is almost invariably when you take a franchise fee and then add the third-party management fee, or in your case, direct costs of management in, it is more expensive in cash terms than the headline number for a brand management contract. So why is it growing is the question if it's more expensive in cost terms?
You mean that it's more expensive that people start to sign with third parties?
Yeah.
Because they are better in productivity. And that is the case. Where is the fight for value growth in hotel properties? That is in 3 lines: revenue, productivity to run the hotel efficiency, and investments. If you look at the revenue side, when I was general manager for like 175 years ago, there was few distribution channels, all of them controlled by brands. Now there is hundreds or maybe thousands of distribution channels, and most of them is not controlled by brands. So if you are capable and understand distribution and online marketing, you don't need a brand for get revenue. That's number 1. Number 2, productivity. We have done transactions the last 10 years in Pandox for about 200 hotels. That's a lot. That meaning that you look at more than 1,000. I never see, not never, but I mostly, when a branded hotel, they had lack of efficiency if you compare it to an independent hotels. And we normally say in Pandox that we can run a business 10% more efficient than a brand. So from 30 to 40% GOP, that makes the whole thing. And the third, investments. A brand wants to have a lot of investment, and you as an owner very often would like to have a more investment asset by asset. You, of course, willing to invest, but maybe less than the brands ask for. So if you don't need a brand for revenue, and you can do the operations better, and you can invest less, why signing a management contract? I have never done it, and I will never do it. And I've been in this industry for 35 years. So I have to be polite to my friend over here, but I can't. It is like it is. This industry will not need more brands. It needs better operators, better general manager, better restaurant manager, better chefs, better analytical who understand how you can get your money back for the investment. Not brands who running around in a helicopter is shouting for more when they can't find any competition level of the revenue yet, because there is nothing. So Frank, it is rather simple. It will maybe grow on franchise, but I don't think you will see that management contract in Europe will grow. Maybe in Asia or in Middle East, there they have a little bit other markets. I don't know them so well. I will say less management contract, hopefully no management contract at all. Some maybe more franchise and more opportunity for company like Interstate and Pandox.
Yeah, I mean, I think in the general world of hotels, it is evident that the North American market is already 70–80% of the way down this journey, and the predominance of management by third parties is the norm. And we're playing catch up in Europe, and the maturity of the market and the extent of brand footprint means that many brands actually are happy to embrace, with the right caliber of third-party operator, franchising as a route to growth. It may accelerate growth. And in emerging markets, it's still entirely logical that brands have a bigger share of their growth through management contracts. So I guess it's partly passage of time. But I mean, Ken, turning to that point, we tend to see, because Europe is in this period of transition, we tend to see this as a confrontational or challenging debate. Whereas I imagine in North America, you're embraced by your brand partners as a route to growth. And, you know, they hold you to deliver against the brand standards. So there's a sense of partnership. I mean, is that not the case? It's not confrontational, is it, between you and the brands?
No, I mean, I think in many cases, no. I mean, in individual cases, we do compete, obviously, but I think over markets, there is a sort of sense of partnership. We work with brand integrity, and the brands, you know, for most of the main brands, where they're after themselves, their second manager. So, you know, we work together on most aspects, but yes, in certain aspects, we obviously compete.
Just following that logic through, I mean, what are Interstate's plans for the Middle East and Asia?
I mean, I think one of the things about a third-party manager is, you know, the focus is very much on service. You take the brand element out. I mean, we're purely providing a service to an owner. So, I mean, to do that, we need geographic support. We need some scale, some mass within a market. Yep. Otherwise, we really can't provide that service. And I think that's the big difference, because some people look at a third-party manager and a brand and say, well, it's just two different, you're doing the same thing, it's just two options to do the same thing. But in reality, it's completely different, because we would have to have a much closer level of support to manage the business successfully. And that's why people would come to us, because we're just providing a service. So to go into another market for a third-party manager, we've got 3 platforms in Europe. We've got a platform in Russia, CIS. We've got a platform in Central Europe, and we've got a platform in the UK. So we run our business in Europe out of 3 platforms. If we were going to go into another market and it was a strategic market, we would set up another platform, because we can't run our business with no people. We need to service the owner. We need to have the operations vice president. We need to have the sales and marketing. We need to have the revenue. We need to have the finance support to run our business successfully. So to go into a new market, Middle East, we would have to set up, and to do it successfully, we would have to set up a platform. So it's either strategically getting a critical mass of hotels, a strategic developer we could work with, or we front the cost and we go into that market, which we've also done, or we buy an existing management platform, which is what we've done in the UK. We've expanded in the UK largely by buying domestic management platforms and consolidating, and then obviously making it part of an international network.
Thank you very much, Ken. Just while we're at this point, it would be great if there are any questions from the audience. Please, if you could just tell the group your name and company, that would be great for context.
So, Tim Davis, Pace Dimensions, it's a management consulting company. Very interested on Eastscape. What are you've spoken about how you compete with predominantly domestic operators, and you're an international operator. What are the capabilities that you leverage with scale to create advantage? What are the things that make people pick you because you're big and global and you leverage scale versus domestic operators?
I think with some investors, some owners, they prefer an institutional partner. It helps them with their financing, for example, is an obvious example. I think we have our own systems. We have some of our own systems, finance systems, that we can overlay into hotels, which smaller domestic operators wouldn't have. We can probably, we would say, recruit higher caliber people because, you know, I think after one of the major international brands, for example, we would be a very acceptable employer. So I think in attracting higher caliber people, both at a hotel level, but also at a corporate level. So, you know, I think those are probably the main things that I would see that we have advantage, and also support. You know, if we take over a platform, if we take over a hotel, you know, we can call in support from our other platforms, we can call in experience from our other platforms, we can bring resources from the States. So, you know, there's that network, so that helps as well.
Do you mind if I just ask
Please.
in terms of, so how do you see the same question? You're not global scale, but you have a different scale. What are your capabilities and how do you leverage that?
Well, we have a little different model. My starting point is to be an active owner, and Interstate is to be an active operator. But we are both doing operations, so they are not doing real estate. And why do we do operations? Because there is lack of good operators. So then, of course, we can go to Interstate, but it's easier to do it ourselves. And we have the Scandinavian background, so we are quite efficient and not have so big headquarters and other things. So that is quite easy when you compare it to many others. But I agree, Interstate, they are a great partner for an owner who like to have someone who is good in operations. So that is what it's about. I can answer a little bit more and say there is 4 models you can choose between: lease, management contract, franchise, and independent hotels. I will say there was coming back in 5 years is leases. When I was head of a hotel company, we just signed leases. That has in some way get away. That will come back. I've been talking about leases for so many years. It's the best working methodology between an owner and operator. If it's linked to your turnover, you share risk, you share upside, you share investments, you're in the same boat. So that will, of course, coming back. And of some reason, and that most likely is financial guys sitting in Wall Street saying, get rid of leases. That is what is coming back area now. And you will see the company who is willing to sign leases, they will grow. The challenge is, and now I'm coming to the most important, why brand will never do it. Because then you need to be a good operator. Yeah, you can laugh, but that's the true story. If you are a good general manager, you can run your hotel efficiency. And if you have percenters, leases, which you most have, then you can fix it. But if you're lazy, then you will have you will have a low efficiency, and you're running a lot of business just for prestige. And then the percenters going down, and then you lose your money because you have to pay too much rent. So that is the next step, and that is the comeback story for leases. I said it for 6 months ago in London. They called me Clint Eastwood. So you can see that I'm right, because when someone starts to say that, then you know I have something to say. Paul, yeah.
There's a gentleman at the back there.
Now as the professor start to talk, now I will be worried.
Good afternoon. My name is Paul Griep from Hotel School De Haek, the Dean. Anders, you mentioned the three components, from which one of them was the investment side. Of course, makes sense. But it made me think of a comment that was made yesterday during the plenary session, where somebody argued for the use of the brand because it ultimately gave a premium on the real estate at time of sale. Now, my first question would be, would you support that argument? And second, do you see a difference between then the operator side or a lease or management contract or whatsoever? Do you see a difference in the sales price of the real estate to your argument of the year? Actually, I asked you, yeah.
I think we're most likely the company who had done most acquisitions in Europe the last 10 years. That is, value is not linked to brand at all. It's linked to cash. It could be linked to location, macro, of course, city, but not brand. That is many years ago. And maybe it is so in the United States. But if you try to sell a management contract today, if you have a hotel with a management contract, then you need to give a discount because of the management contract. So the world had changed. Then I will split up brand in two pieces. One is those who do management contract, and one of those who do leases. If you have a lease with a good brand, then you have a premium. Specifically if that's linked to a guarantee. But that's another story.
Any more questions from the audience? There's a gentleman here, thank you very much.
I'm an active owner, and going back to the question, to the previous question, you mentioned about the value that brand brings to the property, yeah? So you answer saying that there is no value if it is a management agreement, and if it is a franchise agreement, is there value?
It can be, yeah, because a management contract is both revenue and cost. Of course, you know that, but just so I have said that to everybody. And franchise is just revenue. And of course, that could be a brand who have a very strong position in a certain market. And we have many of them. We have a beautiful Intercontinental in Montreal who has a fantastic location. And they do a fantastic job, the management team there with the brand. So they really bring in value on the revenue side, but not on the UP side. No. That is my next problem. So I will say management contract is, don't shoot me, the worst value destroyer in our industry. I'm very humble. I'm from Stockholm.
I developed through franchise agreement, therefore I may agree with you with the bottom line.
Do you agree about my view about the management contract?
Well, I'm first of all an hotelier, therefore I'm an active owner, and I do develop with and through franchise agreements, and I believe though that having a franchise agreement delivers value to the property and gives more liquidity to the property if it is put into the market. Is it true or not?
Yeah, well, answer quick. We have a revenue management center in Pandox, and the guys who are head of that, he always say, to have a franchise agreement is to drive a Volvo safe. To have an independent is to drive a Ferrari. It go quicker, but you can, if you don't are good at driving, that can go very bad. And I think that is a good way of saying it.
I'm not going to ask Anders for his vehicular comparison for a management contract, because I don't think it's going to be flattering. During this panel, I hope to tease out some views for Anders and stop him sitting on the fence. But meantime, Ken, I mean, the rubber hits the road on this issue in terms of, does the third-party manager under a franchise construct actually deliver measurable incremental profit? Now, the difficulty here is there's never a perfect control sample, but you know, in your experience, and I guess you're taking over hotels that have been under branded management, and you're able to measure yourself, you know, through the various STR, Hotstats type metrics. I mean, do you believe that you are able to, when you're selling your services, demonstrate profit outperformance?
I mean, absolutely. I mean, I think you have to look at it logically. People who work for the brand, first and foremost, their interest as an employee has to be the brand. Now, whether it's a corporate employee the person who supervises your hotel, or whether it's the GM who you actually pay his salary and he works in your hotel. His career is with that brand. So, you know, I think as a starting point, the people who supervise your hotel and the guy who runs your hotel are going to have a completely different mindset if they work for the brand or if they work for a third-party manager who is independent and who wants to be aligned to that owner. So, you know, and I think that really is probably one of the biggest reasons. I think thereafter is the resourcing model. As I said earlier, we're a service company. We have to be better resourced than the brand. We have to have closer support to individual hotels, to individual owners than the brand. I think once you put those two parts of the model in place, then obviously you're going to manage the revenue better because you probably have got people that are closer to that market. You've got a GM who's very much or should be entrepreneurial. The same with the corporate people who are supervising. And obviously you've got people who are going to scrutinize, question costs. And push back on some of the costs and push back on some of the recharges. And there's less recharges as well. So I think if you put these elements together, but I think particularly the structural part and the mindset and the resourcing part, there's just a lot more focus on that asset.
But for potential clients in the audience, if you were pushed to express that as a percentage growth in EBITDA, you know, 2 years after Interstate have taken over management, you know, plus or minus 10%, where do you think that actual incremental profit delivery sits? I mean, where's the value add?
I think it's difficult because, you know, I think there can be a huge incremental gain because I think a lot of the major brands have got very major recharges and central charges that go back to the hotel. Now, if you're an owner who is smart, then you can probably, or you've got good asset management, you can probably challenge some of that stuff. But a lot of people don't. So that in itself, recharges, central charges, can be huge. Having a manager that pushes back and scrutinizes and questions this. Now, in terms of percentage, for somebody who's in that environment where you know they're trusting the brand to manage their hotel and they're not a hands-on owner, you could really make major incremental gains on EBITDA. If you're a little bit more attuned to what's happening in your hotel, I've got a good asset manager, then probably it's less. Depends on the market as well. So I mean, there's so many factors.
Yeah.
But if you look at things like hot stats, I mean, you know, the market becomes more sophisticated now. So you don't just have STI, you have people like hot stats that for your market will tell you, you know, how is your hotel performing in terms of, you know, all the main metrics, payroll percentages, cost of sales, GOP, EBITDA, et cetera, and I think an independent manager, a third-party manager, you know, I think again and again they outperform.
Would you ever structure your fees so that you actually back that up and say we won't take our incentive fee out unless we get you, I don't know, 5% more conversion?
I think this is one of the other things about a third-party manager. Our agreements are a little bit more flexible. You talked about it earlier. They tend to be shorter. The exit tends to be easier. And there can be hurdles and things like this within the agreement. Depends what you're taking over, at what stage in its sort of, you know, history is, etc.
By the way, there's some element of that we do. Can I ask you something? When you go into an interstate property and you ask the director of sales, who do they work for? What are they going to say? They're going to say interstate.
I would say, yeah, they would say
They're
interstate.
hardly going to. They don't even know who the owner is.
Oh, I mean, no, I would say I would say, and you've worked with interstate quite a lot. But
so obviously you walk into Fairmont, whichever one, they're going to say they work for Fairmont. Neither of them actually work. No one even knows who they work for. And by the way, they're getting paid by the owner because generally the employees are almost never employees of the owner. So I think we're starting already on sort of a...
But I think when you don't have the loyalties built in by the brand, it's a much cleaner relationship. We don't have a lot of the things that you have to... We work to brand standards, but we don't tell people all the time, you have to sign up so many members today for the reward scheme. You don't have to do this. That's part of what we do because we manage the brand. But, you know, I think it's a much cleaner commercial. You know, I think where people, their mindset is much more clearly set out.
Maybe. What happens, you have 400 properties, so there will be markets where you manage 20, 30 properties, right? What happens when you have a Holiday Inn next to a Sheraton, next to a Hilton on the same street, on Wilshire in Los Angeles with different owners? What happens when I just, you know, where I'm getting here with this is, I'm not sure how owners sometimes get comfortable with that, have an independent manager. I understand what you, obviously I had to deflect some of the stuff that's coming at me and throw it at you because we're just, no, but you know, I'm an owner and I have a Hilton, and the next door you manage a Garden Inn for me, and I mean, what happens, right? How does that work? Or, you know, if I'm an owner and then you manage, I can foresee so many conflicts when you're on the same street. All I'm saying is this will happen with Hilton Starwood as such. Because I'm the little guy here, I tell you, I have one property generally in each market, in each brand. I don't even have this issue to discuss with my owner, right? And so I don't know what's worse. I mean, I think all we're saying here is, I mean, it's a good bashing session. I don't, by the way, necessarily disagree that the world is going, you know, there's going to be a lot more interstates, and you're going to have 1,000 properties anyways, because there is room for that. There's service that needs to be provided, and there's definitely a sound model, right? And some costs are taken out as a result because it's a franchise agreement, and you can kind of pick and choose, and then maybe eliminate some of the central costs, which I don't actually think it's not huge, because generally speaking, when you take either a royalty fee and line that up against management fee, I'm not sure it's all that different if you look at some of the big guys' models, right? And then you may, again, there are cases where, look, I mean, I had Hilton properties in central London where we were running with Hilton management high 50s GOP margins. I bet you it's right up there with you. There was nothing wrong with Hilton managing them. So there are cases where on purpose, I'm not going to mention some Fairmont numbers because I don't want to make it an advertisement, but we have some properties where owner is extremely happy. By the way, is there anyone from Host here? We have a property with Host that's terminable at will, and we're not getting terminated. We're running some of the best margins in the system. So
well, that's a fantastic endorsement, isn't it?
Well, we don't always, you know, I know Anders is Swedish and they're very, you know, like focused, right? I'm not 100% arguing that the operator doesn't make a mistake sometime. I actually am not sure it's in the operator. I think there needs to be some knowledge in the owner or in between the owner and an operator. I think there needs to be someone between you, even though you're independent, as well as the owner. I don't want to make an advertisement for Frank here, but that's where we're headed. Now, Anders is in a special position because he does it all, right? So he can take comfort in that. You know, and in certain markets, obviously, there's the best model.
I'm not advertising Anders' asset management business.
No, I don't disagree with you. You know, look, I don't like your lease model because I think I understand what you're saying, but I think that just is not going to work. If you take it just simply doesn't work, because if you take a lease, whether revenue or otherwise, you know, it's almost like a hotel company taking financing. I mean, I don't know, take this property, 600 rooms, it probably runs 35 million euros of revenues. 30% of revenues is a 10 million lease payment. That's implied 100 million of debt. And I don't own anything. I'm coming here with a huge liability. You know,
we can talk to our friend here from Spain. Do you know that is the most profitable model in the hotel industry? That's the lease model.
But
so please don't give me a chance of talking more about that.
I know.
And if you look at valuation on the stock market, it starts to go up a lot when you see leases. My friend from Spain has signed a lot of leases. Do you agree?
But my friend Gabriele from
So
Spain
lease is a fantastic model if you have two good parties.
No,
Sorry?
So let's just be clear that our friend was there when the stock price was $2 and when you had 12 times debt and 24 times implied debt, and the company was not exactly, you know, seeing to the next Friday, not to be. But I mean, there were not easy times. Okay, when the lease model catches up with you, even if it's variable, when you're paying 30% of revenues, and the top line drops 20, 30% in Madrid and Barcelona, I mean, I'm not accusing you of anything. I've been there as an owner, and there's nothing you can do.
When things were going well, the share was 19 euros.
I understand. I understand. So do we?
When you don't have capital, and if you are lucky, it's working.
I understand. So in 2008, 9, 10, we switched to management fees. 2011, 12, 13, we go to 30% of revenues. When we can somehow figure that out, I'm going to do some deals with others.
I mean, a structure through the cycle that aligns interest would be brilliant. We'll have to let Nick do that as his homework for next year. FRHI, just a word on that. I mean, you have some fabulously wealthy shareholders with very deep pockets, and I absolutely get the organic growth needs to be at a modest pace because you're needing to pick good quality additions for each of the brands within the family. But is this not a time potentially when acquisitions of short chains or portfolios could really bulk up the footprint?
Maybe, but I think at some level, and maybe partly because we're not a public company, I don't think we look every next quarter to have demonstrated 15% quarter-on-quarter growth. So I think there's less pressure. But yes, maybe there would be some opportunities, although I don't know anymore where the pricing has gone and some of these opportunities that we see out there. We can all debate. Well, I don't know. Turn it around and look at us. If Kimpton is worth 21 times EBITDA, someone with Raffles Singapore and Raffles Istanbul and long-term management agreements, we should be looking at maybe that way. But I don't know. I think it's very difficult to find targets as much as people think. We have certain type of shareholders that obviously could provide capital if needed. It's just very difficult to find suitable targets, and for again a relatively small company, even if we do find a target, you know how it is. Everyone at this table knows how it is. It's an enormous amount of work, and then you'll probably lose it to a Chinese insurance company, right, or an account for that matter, right? So I think it's we haven't really found a whole lot, right? Can I just say the good news is what I'm hearing, even from my friend from the north, is that everybody thinks there's some value in the brands. This is fantastic. I'm leaving this panel as a winner. Let's agree on that, right? I mean, no matter what we said, whether franchise, there's some value. We just need to figure out how to better work.
I think we started at a different place. I mean, obviously you're feeling very defensive and exposed, but I think the premise of the panel is management is
dead,
under question. But brands are set to grow. I mean, I think I opened up by saying brands will probably double their footprint in Europe.
That's true.
And at a certain market level, I really don't see franchising being a route. So I think it's the rest of it that's in play. Now, I've spent 55 minutes on the tightrope here, so we're coming towards the close. Could I ask for a couple more questions? Who's got a burning topic? Yes, there's a gentleman here. If we could just wait for the mic and please tell us your name and company, that would be great.
Hi, I'm Max Scala from Prague. We are in real estate. That's the major thing we do, and we own one hotel, which we've owned for a long time. For 10 years, we've been working on a building permit to add 120 rooms, so now it's 160 rooms. Now it makes sense for operators, brands, bigger things, and we are not hotel managers, and it's the only one hotel we have. We're about to sign a management contract, a branded one. So I
this has been a very comforting panel then.
Exactly. My point of view is exactly the one from Andres. Is in real estate we do lease contracts with big tenants, and the hotel business is completely different from this. What's my best way to go?
So just to qualify the question, what's the market level of your property in terms of...
It's upper upscale, best location in town, a historic building.
Fantastic.
Can I go with one suggestion? Would be the one thing to get is a right to convert it to a franchise. If that brand you go with ever becomes a brand that franchises, have the option to become a franchisee or sell it to someone who wants to be.
Mm-hmm. Are you from Prague?
Yes.
You know the people there?
Yes.
Pick the best general manager. And he do it for you, or he or she do it for you. And then you have control. Even if you don't know it, you will learn. Even I learned to run hotels, and I'm not the smartest guy on earth. Pick the best. talk to them. There is so many general managers, good sitting in brand system, had no so funny, reporting twice a day to someone and not reading their reports. and give them a freedom. Call them CFOs or COOs, give them a title, give them incentive, and run it for yourself. And you will be surprised how much better it is.
Martin?
Specifically, if you have a strong location, then what you need to understand more than running it is online marketing. And I can come for a fee and do fix it.
Sounds like a lot of work, though, managing a hotel.
It's a lot of work to run hotels, but it's very fun.
There's a gentleman at the back, if we could just pull the mic back.
Scott Intel with BLP. Ken, because, as your predecessor used to say, Interstate works for the owner and the brand works for the brand, do you think that you get more leeway and discretion with the owners as far as what you're to do, less scrutiny? I mean, certainly your Russian properties, you've been given far more independence than any other owner.
Everyone has independence in Russia, management and otherwise. Yeah.
Yeah, I mean, I think so because, and again, it goes back to the model. We work closer. We have people who are more closely associated with the property and with the owners. So that then tends to lead to a stronger relationship, and then you have, you're given more responsibility and more independence. So I think it's a logical chain of events, and it starts with the sort of the fact that we're better resourced and more probably closely resourced than a brand maybe.
Ladies and gentlemen, I think that it's time for us to thank our panellists for a great and hopefully entertaining session. Anders, Nick, Marty, Ken, thank you very much. Great job, Ken.